Welcome to the Lending Forward podcast, brought to you by Atlantic Bay Mortgage Group. This is your home for real discussions about the mortgage and housing industry. Our hosts are here bringing you firsthand accounts from people at the heart of the business. And we're chatting with professionals from all corners of the industry as they help cultivate transparency around the future of the industry we love. Together, we are lending forward all we know to you. Thanks for joining us for today's episode. Let's dive in. This episode is brought to you by Capacity, the AI-powered support automation platform built to empower mortgage lenders to close more loans faster. Capacity helps lenders convert more borrowers, deliver 24/7 support, and drive revenue by automating repetitive tasks and personalizing borrower experiences. With omnichannel virtual agents, borrowers get instant, personalized help over chat, SMS, email, or phone, from scheduling appointments to answering financing questions. Capacity even works proactively with outbound payment requests, offers, and updates. Plus, with seamless integrations, Capacity makes it easier for teams to find what they need, whether that's company policies or specific GSE regulations, to make faster, more informed decisions. To learn more, visit www.capacity.com.
We are back with another episode of Lending Forward, and today, my guest is Mike Vough. Mike is the head of corporate strategy at Optimal Blue, which is a leading provider of capital markets technology for the mortgage industry. Really excited. Mike brings a deep expertise in mortgage capital markets, generative AI, corporate strategy, and mortgage banking, and is dedicated to driving innovation across the industry. And I'm just so excited to have you on today to talk about how mortgage bankers and lenders and secondary can all work together to effectively serve our borrowers. So, hey, Mike, thanks for joining Lending Forward.
Thanks for having me, Hannah. Really excited to be here. And that was a great intro. I couldn't have said it better myself.
I may or may not have been reading. I have been told that I can follow people around to conferences and intro you wherever you need it. So
okay, I will take you up on that.
Well, I am really excited to have you on. I think, the secondary market is a little bit of a mystery, a little bit of a question mark for a lot of us, me included. Until I took the MBA School of Mortgage Banking 2, I was very much in the dark of how it all works. So if you don't mind kicking us off by just, breaking down the role of the secondary department or the secondary market in the origination process, and to ask a little bit more, break it down like you're talking to a fifth grader.
I've gotten a lot of practice at this over the years, because whenever I was trying to explain my job to people outside the mortgage industry, I would have to try and break it down like it was a fifth grader I was talking to. Kind of the way I think about it is that there's three main daily tasks that a secondary marketing department team is responsible for. So the first is setting the price that they're willing to honor for specific products. So your rate sheet, right? Inherent in that rate sheet is an expectation of future profit. So you say, hey, I'm gonna offer this price at 101 or a 6.25 rate, and I think I'm gonna make 1 or 2 points of margin on that loan. The second part of their job is hedging. And so the way I think about this is that the mortgage manufacturing process is like any other manufacturing process out there. You can even think about it if you were like a farmer, for example, right? You plant a seed of corn. It takes 6 to 9 months for that corn plant to bloom. But during that period of time, the demand for corn goes up and down. And so folks will hedge with that by selling a corn future, for example. The same thing happens in mortgage banking, right? You originate a 6.25 loan. You think it's going to be worth X, but then the Fed does something, a politician does something, and then that appetite for that type of mortgage loan goes up or down. And so when you hear folks talking about hedging, that's what they're hedging. They want to make sure that profit that you set in step one of the secondary process is protected until it funds. And that could be 15 days, 30 days, 60 days later. And then it culminates with secondary marketing departments trying to squeeze out as much profitability as they can at the point of funding. So most institutions that are originating today are not depositories. They're independent mortgage banks. So they're not putting these loans on their balance sheet. What they're doing is they're borrowing money overnight when they need to fund the loan, and then they need their secondary department to go out there and sell that loan to either larger institutions like aggregators, like large IMBs or banks, or to Wall Street directly. And then the secondary marketing departments are trying to squeeze out a couple more basis points at that point of sale. But to wrap it up, it all comes up to, setting that expectation of profitability, maintaining and protecting it, and then trying to squeeze out as much as possible at that point of loan sale.
That's it. That is a good way to explain it. That was an easy to understand way. I hope everybody followed you through it. I like the analogy too, so that helps things. Well, you talked about, changes in the government and changes in everything can affect the market. And we've seen it. I think we've seen all of it in the last couple of years. So if you don't mind, I want to kind of break down all of the different things that can shape or change or just impact rates for lenders. So let's start with economic and global factors. We had the Ukrainian war. We've got, the other things that are going on, outside of our country that are impacting things inside of our country. So how does, the broader economic and global factors shape the market?
Yeah, and it's a very timely question, right? There's so much going on right now domestically and internationally that is impacting rates that, mortgage companies are offering today. And so the way that I like to think about it is, and where it typically starts is with the treasury market. So, the United States Treasury market is, probably that number one safe haven out there in the world. And it's the basis of a lot of other rates that we see there in the market. And when we think about international concerns, whenever there is that flight to quality, right? You're a money manager, you're working at some type of investment fund, and you're like, oh my God, something's going wrong, and I need to get out of riskier assets. You typically run to the treasury market. And when folks want to buy more treasuries, it raises the price of a treasury, but it decreases their yield or their potential return. That basically makes rates go down, right? Mm-hmm. So when people are buying more treasuries, rates are going down. And then the inverse could happen when it's like a risk off situation where they're like, okay, well, everything's great. Stocks are going wild. I want to then rotate out of treasuries into something a little more riskier. And then that could inherently kind of drive rates up a little bit because you need more return to make treasuries more appealing as an asset. Alternatively, too, the Fed obviously is a big driver of this as well, and like the Fed funds rate will kind of flow into things like Treasury, flow into things like SOFR and mortgage-backed securities as well. And obviously, they've got their dual mandate that they're trying to walk that fine line of 2% inflation. Although Jerome Powell kind of was a little wobbly on that recently, and then also maintaining long-term low unemployment. And even with a little bit of unemployment going up recently, we're still at a really healthy level there. So walking that tightrope of those two factors and then trying to maintain independence from the Fed, those are some big things to watch out for right now.
Yeah, there's a lot happening. So we've seen it. We've seen the volatility in the bond market. So how do the sudden shifts impact rate sheets for lenders, and how do we handle it?
Yeah. So hedging is a big part of it. So you definitely want to make sure that you're running a really tight risk management policy. But on top of that, there are things that impact the pricing and the rates that, loan officers see. So for example, when you hear that it's a crazy market or it's really volatile, what secondary is telling you is that it's really uncertain. And when there's more uncertainty, they have to take a more defensive approach. And then again, one more level deeper, if the rates move directionally really quick, And now you have to reprice something that's maybe just becoming the current rate, or it was the current rate and we move really far away from it. An idea here is like, hey, like, it was a 6.5 par, at going rate a week ago, and now it's a 7.5 rate.
Mm.
Well, the 6.5 is harder to hedge now, and also the 7.5 is kind of hard to hedge too. Um, so folks, what they'll do is they'll take a more defensive approach from a pricing standpoint, widen out their margin to make sure they have a little bit more in the piggy bank in case it's their hedge effectiveness breaks down, or the appetite from the investor community to buy the loan we think might go away. So it really comes down to defending the profit margin of the company. And so secondary has that kind of like dual role and maybe like cross that they're maintaining, that they're like, hey, I'm defending the profitability of the company. And so that's something I would just want folks to think about.
Right. Well, all of this, how is it impacting mortgage rates offered to borrowers? Because at the end of the day, borrowers that are, getting the higher interest rates or having to, make the call, do I jump into the market today? Do I not jump into the market? And everybody knows there's a million people waiting on the sidelines for rates to come down, and we all know how that's going. But how is it really impacting our mortgage rates right now?
Yeah. Anytime there's increased volatility, it increases the cost to hedge. And it decreases the little extra margin people make when they sell a loan in the secondary market. So like when that happens, lenders are going to be increasing their margin. And anytime you see a lender kind of increase their margin, it goes back to that point I made about treasuries, right? Price down, rate up. And so when you increase your margin, you're offering a lower price, and that means rates are going up. So, even if you have a high rate environment with no volatility, and then you have a high rate environment with a lot of volatility, in that second example, the borrower will see a higher rate because the lenders have to pad their margin to account for the increased volatility and how that could eat out of their profitability. So right now, again, high volatility, high rate environment, you're seeing higher margins and probably a smidge higher rate offered to borrowers than you would if it was a low volatility environment, if that makes sense.
Mm-hmm, mm-hmm. It does. And I had to ask, you don't have to answer, but do you have any predictions on where we're headed?
This will be me veering off of Mike Vough of Optimal Blue and maybe Mike Vough of Mike Vough Mortgage, but right now, I think the tea leaves, if you look at what we're seeing from inflation and job numbers, I don't really think there's a large appetite to lower rates dramatically. I think we'll see some shakeups on the Fed, and that can make things really interesting. I think we kind of end the year though in that low to mid 6 range, so not much different than where we are today, from like an average rate offered. If I had to put some money on it.
All right, we'll check back with you in a couple months. Well, let's talk a little bit about just the regulatory environment, because that's another piece that impacts this market a lot. How does the ever-changing regulatory environment impact our secondary markets?
Yeah, I mean, it kind of goes back to that margin piece that I talked about earlier. So anytime that there's an additional cost that the lender has to account for, it's getting baked into that margin.
Mm-hmm.
So, the MBA puts out some really good stats about like where margin is going and what's being attributed to. And, the big drivers that you typically see in this are, regulation, and, you can see some pieces of LO comp in there as like the big drivers of margin, right? So as regulation goes up more and more, then you're going to see margin have to increase to account for that. Like they're not like lenders shouldn't be expected to just be like, okay, I'm going to make this up out of the goodness of our souls. Yeah, they have to do something with it. They're like any other manufacturer out there in the world.
Mm-hmm.
So that cost has to go somewhere. So it's either a more aggressive price or it's getting passed on to the borrower.
Mm-hmm. Are there any, and I know you're not like a regulatory guy, but are you seeing any regulatory changes in the future that could affect pricing that, Optimal Blue is kind of looking for?
Yeah, I think like the one that's in the news recently has to be around credit. So we've seen a lot of headlines around FICO and the Vantage score. That's something that we're looking at and making sure that like our technology can handle. We actually released last year the ability to handle the 10T score in some of our hedging and trading applications because some investors are starting to look at that as a differentiator. There's different pieces included in this the credit scoring with these new models, such as not including like healthcare debt, but including rental history. So there are some investors who like that newer metric, and so we wanted to include that there. So that's been a big one. And then just in general, there's been a lot of I would say positive change with things that have been happening with the agencies, with some of their things such as like duty to serve or the mission score. I think we could all agree that those are like really good and like admirable things that those agencies have rolled out there. That we'll see if that continues. But we've made an effort on our side to make sure that stuff's included in all of our technology because there is demand for these products, not just from a policy perspective, but there's some interesting things from like a risk and return to an investor, different duration profiles and things like that of those assets that make them desirable.
Mm-hmm. And I mean, you mentioned, technologies and all that. And I mean, technology is completely reshaping our industry. And I'm sure it's reshaping the secondary market as well. I know OB just announced a new direct lock platform, which sounds really exciting. Do you mind, well, one, talking a little bit about how technology is improving the secondary markets, but also I want to hear about this new direct lock platform.
No, this is I've said this before. I think this is like the white whale of PPE technology. So, but you have to start where we are today. So before we release this, what typically happens is a loan officer is in their PPE, but it's probably framed within a loan origination system, and they're going in there and they want to lock their loan, right? And so they say, "Hey, I like this investor, I like this program, click this lock button." And what was the status quo was the PPE would write a record back to the LOS saying it's this rate, this program, this product, and then it would get picked up by the capital market systems of the lender then. Now, the investor, so let's pretend like you locked it with a different investor than the lender that you work with.
Mm-hmm.
What would happen is someone on the lock desk would actually take the file that was created in the LOS, and then the human would take the file and go to the investor's portal and drop the file and hope that they got the same price and the same rate that they saw in the PPE. So we've completely eliminated that human piece with this piece of functionality, so that now when a loan officer clicks that lock button in Optimal Blue's PPE, it's not only writing to the lender's LOS with all that data, it's also writing to the investor's LOS or platform with all that data. And so it helps lenders from the standpoint of, okay, one less human thing that we have to do, technology, finally that promise of technology investment starting to pay off. And then on the investor side, it's really exciting because they're no longer like captive to a human telling them how much mortgage originations that they have. A big problem for them would be like, hey, it's 450 on the East Coast, bond market's about to close. Yeah. I just got 10 million more locks that just came in. But realistically, they were locked like 3 or 4 hours ago. But, Tim on the lock desk didn't have, he was in meetings, he had to go to lunch, he had an appointment, and he didn't move all those files over. And so they were actually exposed to that from an interest rate risk perspective. And that could eat away at their profit margin as well. It keeps the investors from being able to offer their best foot forward. So we think it's really bi-directional from a value perspective. And we're just super, super excited about it because it's one of those things that I think has always been out there as something that we should have done. And we've got the right investor partners that are helping us get this over the finish line. And honestly, our phones have been ringing off the hook from other investors who want to integrate to this. So we're just really excited about this feature.
That's awesome. I always get really excited about new technologies, and, you do stuff for so long that you don't realize how manual and how slow you are. until you develop something like this. So congratulations. That's really cool. Thank you for sharing a little bit more about it. You talk a little bit about Tim on the lock desk. So, how can loan officers and like the lock desk or just whoever's in their secondary markets, how can they work, I don't know, closer together, I guess, to best serve homeowners, especially in like today's environment where so many are shopping. There's so much noise out there around interest rate. There's just so much coming at, home buyers. Do you have any tips or just insights around, how we can create like this loan officer secondary team to go help educate home buyers?
Totally. And I think historically, there's a little bit of adversarial relationship between the two groups because, loan officers want to close the deal and the secondary side of the house is maintaining that profitability lever. And the number one thing I could recommend is just open and like clear communication of like the goals between both parties. So for example, one of the things that we produce here is this report called an originator scorecard. And I talked about that margin piece earlier, right? Mm-hmm. So higher margin means worse price to the loan officer, which you don't want. And so what we did was we created this report that would look at any cost kind of incurred by the originator. So these are things like extensions that are not paid for, things like a renegotiation that the company lost money on, the idea of hedging cost, right? Maybe you're picking things that are just really expensive to hedge, or you have a lot of fallout, right? Because the capital markets group has to hedge that loan on day one, the moment it's locked, even if you think it's going to fall out, because they could still be liable for that. So we opened up this report and it became this really interesting two-way street between the cap markets group or secondary markets group and the loan officers so they could have this honest communication back and forth. Another angle on this too is the idea of like a secondary marketing department being, very upfront with the loan officers about what products their investors are pricing above and beyond, above like the normal range. So for example, when like new specified pay-ups come out. And so this is additional pricing that is given to certain types of loans. Fannie and Freddie came out with a 325 and a 350K spec pay-up recently. That's something that we should be communicating direct with the loan officers on because maybe they had a loan or a prospect who was in that range. And now there's a specified pay-up that's come in and that means more investor demand. And that investor demand can be passed to the front end of the house. And right, remember what I said earlier, price up, rate down. Mm-hmm. So if there's an additional pay-up from investors, that leads to more pricing power to the front end too. Yeah. But if the loan officers don't know that, if the secondary marketing department is not communicating that, then there's no give and take. Mm-hmm. And same thing with, any other type of like specialty program. You think of Home Readies and Home Possibles, they get a pay up. You think of the Mission Score loans I mentioned earlier. So it really comes down to communication bi-directionally there and just trying to be as transparent as possible from my experience.
I love that. I really love that. I mean, and to take it kind of a step further, looking out like lenders working with investors. I mean, what about there? Are there any ways that are like lenders can better align with the investors on the secondary market?
Yeah, we have a similar version of that report for loan officers, but it's lenders going to investors. And what we typically hear from our lender community is that it's investors being like, how come I didn't get that loan? Or, why are you sending so much production that way or this way? And we have an inverse report of here, which is the lender kind of showing the investor where they're winning and where they're losing and by how much. And then there's other things that investors do. They offer different types of programs, like the idea of buying a loan, but then also buying your hedge too. Mm-hmm. That's called hybrid AOT in our world. And that's a risk neutral transaction for both parties. And there's ways to like make your price better by doing that. But there's things like that. And there's also, this idea of investors, yes, they might want that one loan, but they want to look at the entire some of the loans that you send them, and they might look at it at a more holistic level. And so we've given lenders tools to look at that holistic delivery that they sent to an investor in a month. Another way to kind of think about that is, let's say at Mike Vogue Mortgage, our average DTI is like 45. Well, and that's not great. But if you were at the lender, or the investor, if my average DTI that I was sending you was 46, you'd be like, "Hey, Mike Vogue Mortgage, like what gives? Why am I getting this profile when you have to have some 44 and 43 DTIs somewhere within your pipeline?"
Mhm.
So it's definitely bi-directional there, but it's definitely a visibility, transparency angle here as well.
Mm-hmm. That's interesting. Just all the different relationships. And I mean, I hear it from our team a little bit, but I'm so far removed from it that it's wild to hear you talk about it. Well, I mean, looking ahead, because this is leaning forward, we have to look forward. How do you see this industry? And actually, no, I take that back. How do you see the secondary market specifically evolving over the next 3 to 5 years?
Yeah, I have a couple thoughts on this. I'm going to break it between pricing and then like operational. So on the pricing side, I think you're going to see more and more investors and then more and more lenders move to more dynamic, for lack of better words, black box pricing.
Mhm.
And so with all the API technology out there, the pricing technology, we've seen some investors actually start to adopt this already, where there might be a rate sheet that they post, but if you want their best foot forward, you have to hit their API.
Mm.
And I think you're going to see more investors do that. And then I think you might even see more lenders, instead of having a rate sheet, they might have a living, breathing pricing model that is hit to get a rate in the future. So that would give them the ability to get really granular, right?
Mhm.
Move with the market. Oh, the Fed just released, their latest set of minutes at 2 p.m. Eastern. Great. There's not a mad dash to reprice for every lender in the country right at 2:01. These things are just living and breathing, right?
Mhm.
So I think that's what you're going to see on more of the pricing side. On the operational side, we've seen, and we've done a lot of this at Optimal Blue as well, is that folks are adopting these new technologies, right? Machine learning models, AI, more automation, agents, etc. We've released a series of assistants, and the assistants do what people at a mortgage company or who cover mortgage companies might do. So, for example, they predict how many locks you might have in a
Mm.
day based on historic volumes. They predict what might fall out of the position. They actually will tell you what trade you should put on. They might tell you why you made or lost money. And these assistants I think will be strung together, or at least that's our aspiration here, is to string these together. And you might have the ability to have that, out of office assistant, right? You're at a conference. Oh, it's a summer Friday. You want to go golfing. Turn on this string of assistants and have the position and the trading and the hedging kind of just work. And then when there's something that breaks the normal operating procedure, call you, text you,
Mhm.
and then bring in the human in, right? We're always going to need humans to make sure that these processes are done correctly. But to your point, we may not always need them to be pushing the buttons and staring at a screen.
Right.
So I think that's where I see the world kind of going in those two aspects.
Those are both so exciting. I hope you're right. I really do. I think the world of digital assistants is just scratching the surface right now, and I get very excited about that. So I hope you're right. Well, I can't let you leave the podcast without asking. This is Leaning Forward, and so we ask all of our guests this, and you can take this however you want to take it. But how do you plan on lending it forward for the rest of 2025 and into 2026?
Yeah, I think the main way I've been spending some of my time recently, and I'm a broken record internally here at Optimal Blue on this subject, but just looking at the the non-QM, non-agency market right now. So in our last monthly data report, the Market Advantage report, we actually recorded a recent high for non-QM originations. It was just at 8% of what we saw. And so that's like the equivalent of like VA loans, for example. So it's starting to get that like top 3-4 market share across the different products, right? It's typically conventional loans in that mid 40s. You think of FHA next in that like, 20-ish range. And then typically we see like VA or jumbo loans somewhere in that like 10%-ish range. So that's a big, big market share. And it's really serving a different type of borrower that, because of the reform around Dodd-Frank back in the day, kind of just got boxed out, right? Like I made a joke about DTI earlier. If you've got above a 43 DTI, you're off the agency path, right? If you've got a certain amount of debt, you're off the agency path. If you don't have the right income verification, you're off the agency path. And we've seen some changes with the American workforce, especially when it comes to gig economy, when it comes to maybe more foreign nationals buying homes here, when we think about the idea of Airbnb investors. Also, the agencies raised, investment in second home LLPAs. Maybe some of that we're seeing kind of get funneled into the DSCR market today. You have entrepreneurs who maybe don't have a W-2, but they have assets in the bank, and so they need a bank statement loan. And so it seems like things are really changing there. And so we've been spending a ton of time at Optimal Blue trying to make sure that we're accounting for that. And so that's a big thing that we're planning for going forward this year and next year. And you're going to see some stuff coming out from us in probably, near and medium term future about things that we've been doing with non-QM loans in the secondary market. So I mentioned this secondary market. It's very opaque and kind of even hard to find. It's not as deep and liquid as the agency market, but there's a need for it, because if there's better pricing that we can be discovered, that leads to lower margin and lower rates, right? So higher price, lower rate, and we think that there is some wood to chop there. So that's going to be a focus for myself and Optimal Blue going forward here.
That's really interesting, and I can feel your passion behind it. So I'm already going to invite you back once you've gone down that path a little bit to come back on and tell us all about it, because
I'd love to come back.
I think that would be a really interesting conversation. I appreciate you so much for coming on and lending it forward to all of our listeners, and I really do hope to have you back next year.
Thanks for having me, Hannah. I really appreciate the opportunity.
Awesome. See ya.
Thanks again for tuning into today's episode of the Lending Forward podcast. Be sure to subscribe to our channel, follow us on Instagram @LendingForward, on YouTube and LinkedIn. Catch us every other Thursday with a brand new episode, and go lend something forward today. Atlantic Bay Mortgage Group, LLC, NMLS number 72043, NMLSconsumeraccess.org is an equal opportunity lender and employer. Located at 600 Lynn Haven Parkway, Suite 100, Virginia Beach, Virginia, 23452.